Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Alright, so hi guys, welcome back to the channel. For those of you who are new, this is the Greedy Trader channel. So today we are going to cover what happened in cable. Now I'm just going to go straight to it. Now for those of you guys who are new here, I've got a ton of videos. If you don't know who I am, you don't know why I'm doing this, you've probably seen the thumbnail. Again guys, this is where we say there's absolutely zero BS on this channel. You know, that's how we like it. We know there are a lot of people out there who are just spreading a lot of BS. Some of them probably even never traded in their life. They've collected a ton of subscriptions from lots and lots of different people. They've gone out, bought themselves a Lamborghini, and marketed themselves that way. More people have paid more money. Undoubtedly some of that gets recycled back into some form of trading or trading platform, whatever, and then the end result is someone getting incredibly wealthy off the fact that you're donating to them. And that's perfectly fine. It is capitalism after all, so everyone can do what they want to do with their money, but in this channel that's not what we do here. Most things I provide you for free, so if you peruse the channel you learn a lot, and at 15 years in this business I like to think that I'm the real deal. But in any case, let's jump back into cable. So what I would want to touch on, because I had a lot of questions around this specific trade, what happened to cable, so I'm just going to zoom in here so it's perfectly clear. Oops, I don't want to lose a lot of the screen. But so essentially what do I always say is that, one, we always want to look for demand areas, we want to look for liquidity. Now for me, depending on where the trade is coming out on, whether it's strong liquidity or demand, becomes the question. So we got a couple of different steps that we need to go through. Step number one, you've got to ask yourself, where's the demand area? So let's take a look at this. If we go back historically, when we say demand, we're looking at something quite specific. We're looking at, see the bars at the bottom of the screen? That's what we call level 1 volume. So we're looking specifically at level 1 volume. And if we track the level 1 volume going back in time, you can, and again we're talking about this trade, right? So we're going to pretend that none of this had happened. You were in the middle of the market and all you could see was the price action here. If you look back historically, you can see the volume on each session that opens. So the London session will have some volume greater than the Asia session, and the US session would have volume greater than the London session. If this doesn't happen, that in itself is an anomaly. It could alert you to a couple of things. It could be there's a news event coming probably a lot later in the US session, for example, or the following day, or it could be that a lot of the volume traded in an earlier session, let's say for example Asia, and if that happened, then it's likely a front run and you would see that reflected in the price action. So looking at volume is really, really important. So if we take a step back, if we go all the way back in time, we can track that volume. So we can see on the 8th of March there was a huge volume spike, and that is the New York Open at 1 p.m. Okay, so it makes sense. We had a massive volume spike, and that's followed by the Nasdaq Open at 2:30. So that 2 p.m. window we get a bigger volume spike. But if you look where it's occurring at the top of the market, and it's a major session. It's a US session, right? So inevitably we can see the price action resulting from that was a downward spiral, right? And that's supply, right? So that's a supply zone. So we're aware of that, we can mark that off. Since the price is going down, I'm mainly interested in the demand zones. So if we go back, we track the volume back, and we're saying, well, where is the market likely to find passive orders, right? And that's what we're doing. And we know this is true because anyone who has access to level 2 dome, for example, has seen where the passive orders is, because again, the book is 10 deep. right? So you can see 10 price lines deep, which means that you can see where the order stacks are. So it's a little bit easier if you're using a dome. You don't really need to go through all of this because you can actually see the orders. Now, what we do know in the dome, for example, is if you've got a dome, you get other practices like spoofing, pulling and stacking, right? And this is because algos are consistently doing weird things with passive orders to trick traders, right? Because this is a zero-sum game. So if you see that, then you can make some very educated deductions without needing to have a candlestick chart to tell you. But I find level 1 volume incredibly useful and simple, because as a beginner it's a great way to start rather than trying to jump into things like dome or footprint charts that require you to have already the basic concepts, and a lot of people don't, and they want to get into this kind of trading. It can be very difficult. So if I go back historically, I can see that on the 7th of March we had a huge volume spike here, and that was in the New York Open. So this is the highest volume that we've seen on the buy side, because prior to that it was just supply volume. So I'm going to put a demand zone here as a possible area that the market could react. I don't know this for sure, but if we break through, then it stops being relevant demand. But it becomes a great place to look for a reaction. Whenever you're trading off a demand zone, you want to look for a reaction first. If you just go and pull the trigger, then that trade could be a losing trade. If your risk management is good, it's not a big deal. You probably get another trade. At the same time, you want to protect your capital, so you want to make sure that you're making those what I call high probability trades, because that's the only way you're going to make money in the long term, is if you're going after trades that are more likely to work.
60% of the time, it works every time.
So demand zones are good, but again, they are not the most reliable places to trade off, but you want to see a reaction. If you see a good reaction, then you can trade off it. So we can see that happened here. So we traded much lower, and then eventually we hit that demand zone, right? And then you can see that happened pre-market, or well, actually it's not, because we've got a time zone shift. So it's actually 1 p.m. but because the time zone shift, 1 p.m. In London effectively, which would have been the New York Open, is now changed. It's now 12 noon. At the end of this month, we are going to catch up with the Americans who've had a move in time, right? So let's just think of this as 1 p.m. That's what it is, but it's actually 12 noon, right? So we can see that New York Open, big spike, and then we can see what would have been the Nasdaq, which is now the 1 p.m. 2 p.m. window as opposed to the 2-3 p.m. window, and that was the Nasdaq. So again, when we got this pop, what we're really looking for in terms of an entry, and for those guys in my Discord server would have seen me say that, and by the way, my Discord server is free, right? So this is not an upsell for my Discord server. You can join me if you like. I will make sure I leave links in the description or comments, and then if you're happy to join, you can see what we do there as well, right? So again, if I were to do that there, that will be a typical entry, right? So we just want the market to pull a little bit into the tail. I like it like 50% of the tail, that becomes a good buy, for example. Now again, whatever your idea of risk reward profiling is, you can look at that, whether you're the 1-to-1 type guy, or you're the 2-to-1 type guy, or the 3-to-1, whatever, right? But I always look at take profits in terms of taking where there's liquidity, right? Getting out where the market says you should get out, rather than, you know, some arbitrary figure of 2-to-1, 3-to-1. This might not be possible. You'll be holding on to trades, and you're going to lose more of your trades or break even more of your trades just because you're running into supply and you don't even know it, right? So typically, on a move like this, I would look for a liquidity high, right? We've spoken about liquidity highs before, which will be the next thing I'll come to, but I would look for a liquidity high. And that's a typical trade. So we've set up a stops underneath the demand zone, because really and truly, if we go under there, then it's pretty much open season. So we've got that. And then also, if you want to extend it out a little bit, so for example, you can look at the open of this bar here. You can try and get under the bar, and that's perfectly fine as well for a stop. Realistically, you've got 22 tick stop here. Absolutely nothing wrong with that with your entry. It's going to a liquidity high. It's going to give you a 2-to-1 on average risk reward, right? But we want to look where the market's heavy. It's very possible we might have to jump out earlier, just because the market's not going to allow us to achieve that. If we have access to a level 2 dome, for example, we'll be able to see where there's maybe a big offer stack that might cause problems for future upside potential. So that's the first step, right? So we understand what a demand zone is, hopefully, and we understand what we're looking for to get one of those demand zones. Now, the second thing I consider, in addition to demand zones, is if I'm going to take a trade, it has to be in a liquid session. There's no point taking a trade at 11 o'clock if you're in London, 11 o'clock in the morning, 9 o'clock in the morning, 10 in the morning. This might not be ideal. The reason for that is that is not the most liquid session. Again, I don't even like taking trades on a European session unless it's obvious. And the reason for that is that we're going to get a bigger session that might have a bigger idea or a different idea. And that could potentially end up completely moving your trade in the direction you didn't even think it would go, right? So it's very important for you to take trades in sessions, the strongest session, which is the US session, when it's most relevant or at a relevant zone, right? So for me, this was a really great trade because one, it was in a major US session. Two, it was coming off a demand zone. So that's 2 check boxes already for a potentially good trade. It's not quite out of a liquidity zone. It kind of did tail, but we like to see a cleaner push if we're going to add liquidity as a checkbox. So liquidity wasn't the reason why it moved. It was more due to the demand zone. So at this point, if we break the upside here, we can expect that this market will go parabolic. It will go much further. The next side, we have supplies up here. More than likely, we're going to push and maybe take out the liquidity highs just above 28.94, right? So that's the second thing is it a major session? We want to be able to check that off. If it's not a major session, we want to wait so we see what happens in that session. Now, this should be common sense to a lot of people, is that if you're going to take a trade, why take it before the biggest traders step into the arena? It's like, I don't know, it's like you're supposed to fight Mike Tyson, but all of a sudden you see Mike Tyson's kid in the ring and you say, well, actually, you know what? Mike Tyson's kid is pretty tough, so I'm going to take on him first, and if I can knock him about, then that's great. But then all of a sudden Mike Tyson steps in, and then you're like, oh goddamn, you've wasted all your energy on Mike Tyson's kid. You might as well conserve it for Mike Tyson, right? Because he's got the potential to kick your ass. So in any case, that's kind of how I look at the market, is that I want to trade with the best. I don't want to be taking mediocre trades. Again, if you look to the downside, you can see other historical demand zones that are likely to be of relevance. One of the biggest ones is, so let's move this up a little bit, so there's this one here, right? It's already been, markets reacted to this before, but if we're thinking about a demand zone, that's what we're looking at. Now, there are a couple of nuances when you're building demand zones, right? And the other aspect of it is I like to look at the lower third of the candle, right? So because that's where, if you've got a CPO chart, you'll be able to see that quite clearly, is that's where the bids and offers stack, right? They stack at the lower part of the candle, right? So if you're looking at a market profile, you will see bid stack and offer stacks usually in the lower third of that profile, or the upper third of that profile, right? It's rarely do you see it in the middle. Occasionally you do, but most of the time those bid stacks don't hold up as well as ones that are in the lower and the upper third, right? Because that's a clear indication that there are a lot of sellers. Again, if you don't know anything about market profile, I've got a ton of videos that already cover that. So what's the potential now? So we're driving now into that major US session. So we're about to kick off the New York Open in about a couple of minutes. When that happens, we'll be able to assess as to what to do next. Likelihood is that we're probably going to keep pushing higher into liquidity zone at some point. So I'll look at 128.23 and then judge what the reaction is. There's no relevant supply up here, so the chances we break through that can also be quite high. Structurally, the way we're setting up, we've got an impulse, correction, likely another impulse, and then maybe consolidation and continuation, right? We don't know. This is what I always say to traders is, stop listening to people who keep telling you that, oh yeah, I'm getting in this trade and it's going to go here and then I'm going to, no, that's not what's going to happen. What's going to happen is what the market says is going to happen, which you will only find out when that session opens. So you need to keep an open mind. So usually if I'm talking to traders, I say keep an open mind, right? Liquidity highs, good level. If we get a nice little reaction, we start coming back in, then you could end up with a really big sell-off. Regardless, we've got strong buyers here. It's very possible that those sellers that step in are going to make these buyers pale in comparison. But you'll be able to see that by looking, 1, at the volume, 2, at the level you're trading, and then you can react off that. Again, if you have a market profile chart, you will be able to see where the offers are stacked, and that gives you a very good idea of what kind of price level we're going to hit and where that's going to come out. So for example, you can see my market profile chart here. We've got a huge offer stack sitting at 28.45 to 28.53 kind of a range, right? We've got a mini offer stack sitting just above 28.19 into probably that 128 sort of 23 area, right? So these are all potential areas where the market could get hit and pushed back down again. So we're looking for that, right? So with a profile chart, you can make a few more, I would say, educated guesses than maybe you could do with a candlestick, because you have a lot more data or information on a market profile chart. So that was just a snap here on that particular trade that we're talking about, why I said it was a good idea to be long at the time. And yeah, this is it, guys. There's nothing else to it than that. So we just need to think a lot more about our trade locations, think a lot more about what kind of methodology are we bringing into the market. Are we bringing something arbitrary, or are we bringing something solid? If you're talking about volume, you're talking about solid things, because we're talking about the order flow here. It's where traders have reacted before, where there was clearly visible demand. We can track that because we can tell that the volume trading here was directly responsible for the price move up there. So again, if you follow the old Wyckoffean logic, right, which is, you know, if there's effort versus result, right? If we see some effort, we got to see the result of that effort, and if we don't get that, then there's something wrong. Market's being manipulated. So we need to be aware that manipulation is part and parcel of modern financial markets.
Try to make me look like the bad guy in the situation. You've been manipulating all of us.
So we have to always be watching for it, and that means that our trade locations have to be very specific. So as you can see, I've mapped out those very key demand zones, and as you can see, I continually do this, and the market's reacting to these zones, not because of me, it's because it makes sense that if there was a lot of volume here and it pushed the market higher, the market should respond to that level again, because that's where the bigger trader who executed that is likely to rebuy or defend his position. And if that's the case, then we should see the market move out of that level. Again, if we see volume on the top side, for example, like here, we can say it's supply, and it's happening at, in this case, 2 p.m. That's the Nasdaq opening window, and then we start to cut back, then that becomes a really good shorting area. We're above a liquidity eye. We could get a move back in, but then we have to be aware, okay, there's demand sitting here. This is not the highest volume of the day. There's higher volume sitting here. Usually the highest volume should be at the highs. It shouldn't be at lower prices. That is an inefficiency. The biggest traders have a lot more information, so they can afford to wait and be patient to trade at the most advantageous price. And if they can do that, it means that the volume needs to reflect that. But this is not the case here. So it tells you that this at best is going to be a correction back into where the demand is, which will be the lower third of the candle, and we should get a reaction from there, right? It was the wee hours of the morning, it was Asia, so it didn't really matter. You're not going to be available to trade it. But then coming into a European session, right, so we opened at 8 a.m. consolidating, it becomes a really good trade if you're thinking about a continuation. Again, I don't like to trade out of Europe. I would rather wait and see what happens in the US session and see if there's a tradable opportunity. In this case, it was rather obvious that because of the consolidation into the demand zone, there was likely to be continuation. Again, you have to have your own trading model. If you want to look at it this way and you're comfortable with being dynamic with what you see, then this is a great way. Other than that, grind it all into a checklist, right? Pick a particular way you like to trade. Maybe you just like to trade off demand zones, so you're looking for reactions there. Maybe you like to trade in Europe. You're going to have to get out of the market rather quickly into the US session, so you're not going to be able to hold continuation trades, right? Because if you wait till the US session, your whole trade idea can come apart. So these are just things that you have to be aware of. Anyway, guys, hope you enjoyed the video, and until my next video, adios.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses And a condo.
I'm considering going long on April wheat. What do you think, Valentine?